Let me welcome on board our next expert and figure out where he sees the market headed from here. We've got Jitendra Arora from ICICI Prudential Life Insurance Company joining in on the show right now. Jitendra, hi, afternoon. Welcome to ET Now. Just wanted your take on what you're making the trend across the banks, because there clearly seems to be a growth slowdown and a liquidity crunch clearly, and I guess that's what's reflecting in the stock prices too.
Yes. Hi, good afternoon. As you said, that clearly, I think short-term factors are right now dominating the banking sector per se, wherein we are seeing that uh, because of tightness in liquidity in the system, we are seeing shortage of deposit growth, which in turn is also affecting the cost of funds, and as a result, leading to some kind of NIM compression for a lot of banks, and also elevating their CD ratios. So as a result, we are seeing that banks' earnings are coming a little bit under pressure, and market has been reacting to that. Let's not forget that along with this, banking is perhaps one of the most heavily overowned sectors within the Indian market by both FIIs as well as domestic investors. So as a result, when the earnings are not being as supportive as they can be, we are seeing some kind of selling in the sector. However, if you ask me today, I think this is still one of the best sectors to own in the Indian economy, because we believe that the construct of the sector is that at least for the last private sector banks, they are likely to outperform the nominal GDP growth by anywhere between 3 to 5 percentage points on a long-term basis. And so if I'm getting this sector today at which is likely to reflect a 15% growth over a longer period of time at roughly 2 times book for almost anywhere between 15 to 17% ROE, I will happily be adding it to my portfolio.
Sure. The other thing is, of course, there's value on the table. But where is it that you see a combination of growth and value in this market? Because, pretty much all sectors out there do seem overvalued right now, or at least fairly priced.
So that's where I said that banking perhaps stands out, where we see value as well as growth. So if we are willing to overlook the next couple of quarters and start looking thereafter, we will see that the NIMs, which are compressing right now, will perhaps base out, and thereafter they will start either stabilizing or going up per se. And also the earnings growth will be back. Let's not forget that despite all the negatives, banking sector earnings are still expected to grow in double digits over next year, which if we compare to IT sector are still much better off, which has been bought over by the investors of late. So we clearly see value and growth both in the banking sector and with a lot of valuation comfort per se.
Right. I obviously, Jitendra, meant what other than banks is looking lucrative at this juncture, or is it only banks?
No, so banks are perhaps one of the sectors. Along with that, I think given that the way the consumption stocks have been beaten down over last few quarters because we've seen a slowdown in consumption, let's not forget that some of these names will have levers which will be related to distribution. So they can continue to grow in mid-teens to high teens or at times even in 20s over next 5 to 10 years. So even though the valuation there may seem to be a bit expensive, especially given the recent slowdown in earnings, we still like those names and continue to add them, especially now.
So that's good to hear. Jitendra, hi, this is Anish also joining in the conversation. I wanted to understand your take on real estate and building material as a space. Do you think the best is behind and one shouldn't look at chasing that rally anymore?
So in terms of demand, I think we still are at a point where demand is likely to be robust, though the valuations have moved up significantly over last few quarters. And hereafter, I think how companies are able to generate cash flows will determine whether the current valuations stay or we'll likely to see some correction. But a short-term correction, I'll not rule out, given that the rally has been fairly sharp over last 3 months.
And also your take on the public sector entities as a whole, because last year was all about that massive re-rating and people were calling it a long-term or at least a medium-term cycle at that. Do you think that's over, or will you still bet on the public sector entities, whether banks, whether defense, railways and the other infrastructure names?
So I guess one has to be selective there, because we have seen that given that public sector was doing well, so all the public sector companies have been re-rated. There are names in financial sector within public sector now that are trading at 3.5, 4 times earnings for growth and ROE profiles, which will be perhaps similar to, if not worse than some of the large private sector banks. So clearly the valuations are getting stretched in pockets. However, there is still value in a few names, and one has to be selective as a result.
Right. Jiten, great to have you join in and, share with us your thoughts on the markets. Good speaking with you.
Thank you.